Thanks for joining us today on Market Call. I'm Morella Fernandez. J Zechner will be with us on the show. He's chairman and founder of J Zechner Associates, and he will take your questions on North American large caps. Here's how to reach us: 1-855-326-6266 if you would like to call in. You can also send an email to marketcall@bnnbloomberg.ca. John, good to see you.
Hey, Morella.
So weaker job numbers in Canada and in the U.S. Do you expect to see more weakness carry on for the end of the year?
Absolutely, Morella. And yeah, sorry, I can't be in the studio with you today. Usually this is a tough one to do remote, but I could not get out of Collingwood today. But anyway, yeah, on the economic picture, I still expect more weakness. I've been sort of bearish on this, and the economy has been relatively resilient so far. But I mean, you take a closer look at some of the numbers we've seen recently. Look at the Canadian GNP from the second quarter, negative. Look at those employment numbers in the U.S. last week, around 70,000, or down to 30,000 monthly gains. No one seems to talk about the beige book, which, the 12 districts reporting in the U.S., and that was just awful. I mean, at best, some of the regions said it was neutral, but most were sort of negative. And then even this morning, the revision to the employment numbers over the past year, 912 to the downside, which means your average gains last year for employment end up being more around 70,000 rather than 140 to 50 reported. It's pretty, and I think what the reasoning is companies aren't laying off because of migration changes and immigration changes and everything, and there's not as many workers out there, but they're not adding jobs. And I think a lot of that is the unknowns around the tariff regime and trade right now. Companies' capital expenditures, employment increases, those are made going to be based on long-term economic conditions, and in these investment decisions that need a more sustained, viable, sort of clear economic outlook, and they're not getting it outside of getting a few getting pushed and shoved into doing that. So I think that all adds up to weaker economic numbers over the balance of the year. I think the Fed cuts 3 times. I think they go 3 by a quarter. I think the Bank of Canada goes back into an easing mode this week. We've had a position in long bonds, which has not really worked out that well this year because the curve steepened a little bit, but I think it's actually looked better in the past week or so, and I still think rates are going to come down. So whether the shape of the yield curve, I'm not sure. And on the equity side, yeah, valuations at all-time high. People are bullish. I guess if you're bullish, you say everyone's bearish. If you're bearish, and everyone's bullish. Forget sentiment. The invested positions say everybody's in. When you look at cash and institutional accounts, when you look at the holdings of the average a U.S. investor and all of that, that tells you everybody's in on this. So valuations at record high, economic growth, I think, is at risk, which puts earnings at risk. To me, it just means get more defensive. Don't go running for the hills, going to chase. But if we kept a lot of our existing positions on, I just cut the weighting of them. I cut the weight of a lot of the tech positions and other things, and I'll look to buy them on any weakness, and sort of out of more of the cyclical names and more of the defensive areas, interest sensitive, utilities, telecoms, pipelines, areas like that. Okay,
so you've told us what you're doing. Are you seeing others do the same, sort of rotate out of the tech? We know some of those big tech names are coming down from their highs and haven't sort of bounced back yet. You're trimming tech as well. But do you expect those big tech names to come back? And you said you might sort of dip in if they do drop enough?
Yeah, we do, Morella, and it's a good point because everybody's talking about the broadening trade recently, and the expansion and the Russell 2000 having a great month in August and all of that, and I really question that because the problem is a lot of the small caps, the cyclicals, the value stocks, and things like the Russell are way more economically sensitive, and I think those are the ones that are going to have a harder time growing in this slower economic environment. You take out the tech from this earnings growth in the past quarter, like never mind the 12% you saw under 5% for the rest of it because you saw better than 20% in tech. So I think tech for now continues to deliver this 20% earnings growth. So I'm not, we've reduced our positions in the name, but we're still got a healthy position in tech, probably 12-15% of our equity portfolio. Nothing like what the U.S. weight is in the index, but still it's one of our largest, probably is our largest sector weighting still. So it's I think they will continue to deliver. for now, let's see how the AI plays out. I lived through the late 90s and early 2000s, so, I got a clear memory of this, and then something similar in the mid 80s too. So, we'll see how it plays out. I think maybe the expectations are a little too high on the AI side, but who knows? Everyone says it's paradigm shifting.
Yeah.
Maybe it is.
Some would say because you've lived through that, you know what to watch for, right? You're watching the signs more closely than others.
Maybe a little jaded. I'm not sure.
John, we're going to leave it there for a second. We want to line up some phone calls and some emails for J Zechner, J Zechner Associates, taking your questions on North American large caps. We're back in just a moment. Welcome back. J Zechner with us today to take your questions on North American large caps. We're going to start with an email from Sarah. She said, do you like CRM, Salesforce, for the AI play at these levels? Salesforce reported, some are wondering sort of what the road ahead is for a company like Salesforce, which right now doesn't seem to be doing great. I know they're incorporating the AI a lot, and maybe it's helped them within the company itself, but it doesn't seem to be playing well yet thoroughly for them. What do you think of Salesforce?
Yeah, you know what? We've actually been buying it in here, Morella. Software as a service, SaaS, has done really poorly this year. This stock's down like 35% year to date. Adobe's down a similar names because, a lot of people are worried that software as a service is going to get displaced by AI effectively. So these companies have been under a lot of pressure. So there were a lot of eyes on the most recent earnings report from Salesforce and, how is Agentforce doing? Are they able to roll that out? Are they getting their customers to pay for it? Because this has to be, obviously, the next step of the rollout of AI. You've seen all the spending side, you've seen all the money going in and the hyperscalers and all of that, but there's got to be a rollout where it's profitable for the users and the software companies ultimately to deliver this. Salesforce seems as well positioned to deliver that, but they didn't really do it with last quarter's numbers. No really got too excited about it. I mean, said that the stock's trading mid 20s times forward earnings, like 12-month earnings. That's not a bad multiple historically for the stock. They're well positioned over multiple apps, and they've got a great ownership in the institutional market. So I think there's a potential for them to grow. So I think this is more the migration we're doing. We've been coming away from the guys who've been building the data centers, sort of the stage one of the large language models and all, and sort of moving more to the inference stage. A lot of people are talking that now, and I think that makes sense, which means adding more of the software names that I think will be beneficiaries in the ultimate AI rollout and may ultimately be the ones who profit from it. Because if the front end doesn't start to profit at some point, this whole thing is going to slow right down, and we're going to see a repeat of 2000 telecom spending all over again.
Yeah. Okay. We hope that helps Sarah out. We're going to go to Chris on the line from Victoria, BC, with his question. Go ahead, Chris.
Thank you, Morella, and hello, John. John, I've heard you speak on Pembina Pipeline a few times in the past, and I would like your opinion on this stock for, say, a 5-year hold, and then as well, if you don't mind, in 2020, so about 5 years ago, I borrowed a considerable amount of money through a HELOC and bought Enbridge, and that has proven to be quite a successful endeavor in terms of interest and dividend and deductibility and capital gain, et cetera. And I'm wondering if you think that is still an appropriate strategy for the next 5 years, with another pipeline, in my opinion, Pembina looking the most attractive.
Okay, thank you for the question. Enbridge has done well and is at record highs, I believe. I haven't looked at it lately. And Pembina has lagged a little bit. It's about $5 down from the high in April, today at 53.06, John. So up a little bit on the day. But talk to me broadly first about sort of oil and natural gas, because we've seen lower prices for both. When you have a pipeline involved like Enbridge, then, of course, that's not going to matter to them. They're just carrying the product, per se. But what do you think of the space, first of all? And then let's get to Pembina more specifically.
Well, first of all, something about that beautiful air out there in Victoria and must make you a great risk taker. Actually, we just had a great family vacation out there in Cobble Hill, just north of Victoria. Wonderful area. So anyway, thanks for the commentary. Yeah, Pembina we like. That's one of our top picks. I mean, I didn't make it a top pick today, but I like it. I mean, they've been hurt in the past year, and you mentioned that, Morella, and I think that's mostly because of the worries around, tolling on the Alliance pipeline. I think these guys are as well positioned as anybody for growth forward in energy infrastructure, and this has got to be a key for Canada. I mean, I keep looking at it. Why are we talking about more selling LNG into Europeans and all of that who are going to go off the Russian gas? I think there's great opportunities for infrastructure spending in Canada to increase our deliverability to areas other than the U.S. and pipelines are going to be front and center on that. I mean, that call you mentioned on Enbridge, I see that was a good risk-taking call because I remember it was around that time that Enbridge was had a dividend payout ratio in excess of their earnings. There were a lot of worries about it, but in the end, it was absolutely safe. They delivered, never cut the dividend, and the stock's done exceptionally well. I think Pembina is in the same sort of penalty box right now. I think, except they have more levers for growth. They got a lower valuation. They got a decent dividend yield while you wait. And I say, yeah, I like it. I like energy infrastructure. Pembina would be near the top of the list of those holdings. So I would stick with it. And yeah, it's basically gone through a rough period, but I like the opportunity to buy things on the cheap, and I think that's what you're getting here.
Okay, we are going to go to Scott just before a break. Scott's in Toronto. Hi, Scott.
Yes, good afternoon. I'm calling about Rogers and TELUS. John, I'm just looking for some income as opposed to putting money into a high-interest savings account. What do you think about Rogers and TELUS? Thanks.
John,
well, if it was just just income you're looking for, I'd be probably on BCE credit of the highest dividend yield of the group. I think the worries about the telecom sector have passed in my mind for now, because I mean they had this issue of the fourth player coming in, Quebec or with Freedom Mobile, pressured all the wireless players, led to a bit of a price war. At the very same time as we reduced immigration in Canada, so there was no new students coming in and getting new cell phone plans and everybody else, and the sector has been just decimated over the past almost 3 years. I think that period is ending now. So I think all the names in the sector look interesting. I would take Rogers personally. It doesn't have the biggest dividend yield of them, but I think it's the most undervalued, mainly because of the sports assets and what they'll take into what they've done with the Shaw acquisition and the synergies and the growth going forward from there. TELUS is a great play as well. I'd have to look at what the yields are on both. I imagine that TELUS has a higher dividend yield right now, so it's pure income. I don't think any of them cutting the dividends. That BCE was at risk, and that has come and gone. So I like the sector. We own all three of the big names. Rogers is my favorite, but as an income between Rogers and TELUS, I'd probably take TELUS on that basis alone.
All right, BCE, of course, parent company of this channel under the Bell Media brand. We're going to take a quick break. John Zechner sticking around to take your questions on North American large caps. Back in a moment. Welcome back to Market Call. Let's go to Greg on the line from Toronto. Hi, Greg. What's your question today?
Good afternoon, Morella and John. John, first of all, I want to say I really appreciate the experience and a little bit of gray hair, and I love listening to you. My question is on Barrick and the gold sector in general. Now, I've got quite a lot of gold stocks. I'd resisted buying Barrick. It seemed so cheap that I bought it, and it's moved lately. My question on this, Barrick traded at a higher price in the late 90s than it did in the early 2025. So this sector obviously is really cyclical. How do I harvest my gains in the gold sector, not leave it all on the table in relation to Barrick? And what do I do? Is Barrick potentially a long-term keeper because of their changing investment in copper? And their investment in gold as well. I'll hang up and listen to your reply.
Okay.
Thank you.
Thank you for the question. Barrick, by the way, at 29.04, which is actually a high on the stock. It was down to, at the end of last year, 15.23. Do you like Barrick moving forward?
No, I would not put Barrick near the top of any list. I mean, it has lagged the group in general for a number of years. I mean, we started investing in Barrick in the mid 80s, and I remember it was a great growth story for years and years, with the Gold Strike property in Nevada. But really, over the last number of years, they've done some very bad acquisitions. They basically had no top line growth, and that's why the stocks lag the group. They've caught up a little bit this year, obviously, just because of the move in gold prices. No matter how you measure it, they're a massive gold producer, and they're going to do better. I like the group in general. I think gold goes higher, and even if it doesn't go for higher from here, I think the stocks are very cheap on a historical basis. I think there's also a wild card on the gold side here that could be very well is that I think when you look at the U.S. debt situation and how do they ultimately get out of it, they might inflate their way out. I mean, that was the way South America got out of their massive debt programs in the 70s. Effectively, you depreciate the value of your currency and it depreciates your liabilities and helps you pay them back ultimately. I don't know that that's what's on the table right now in the U.S. administration. They would want to talk about it, but I tell you, there's a part of me that sees what they're trying to do, and with Trump's push on making changes at the Fed and all of that to drive interest rates down, you could light a fire under that, which would ultimately be inflationary, bad for the U.S. dollar, and even more positive for gold. At the same time, the central banks keep buying. I mean, it's now become their biggest holding next to the U.S. dollar. I don't think that central banks aren't traders. They don't start a trend and then suddenly stop. So this will continue. The stocks are cheap. Barrick would not be near the top of the list. If you've got a lot of gold names, I would probably take the profits on Barrick and stick with some of the other ones. There's others there that I really would be more in favor of because of better valuation and certainly better production growth.
Okay, John, thank you for that. By the way, I should mention I was looking at the American market. The Canadian market has it at 40.19 today, as we saw. Let's move on to Mac, who's calling from Tamarack, Ontario. Hi, Mac.
Hi, good morning. I'm fairly heavily invested in energy stocks. It seems that it looks like natural gas is the way to go in the future. It's kind of a two-part question in a way. I bought Tourmaline and I bought ARC Resources for their natural gas. I'm thinking about reducing my energy. I'm up like 25% total energy stock, so I want to reduce them. My question is, first part is, which is a better stock? I've lost money both on Tourmaline and ARC Resources. Which one should I keep if I want to keep them? Or the second part is, should I keep them both and reduce my heavy oil stocks, like, say, for example, Suncor?
Okay, John, which one do you like between Tourmaline and ARC Resources?
Quick answer there is I would take ARC over Tourmaline. They're both great companies. I just think ARC did that great acquisition of 7 Generations a number of years ago. They've migrated a little bit more to light oil. They got the attaché property. They got better growth potential and a much lower valuation. And I agree with the caller that the idea of some natural gas plays probably make more sense than oil right now. I'm pretty sanguine, bearish, what do you want to call it, on oil in general. I keep thinking with slower global demand and with the fact that OPEC Plus is now putting more production back on the market, I still think we might test $60 again on the price of oil. So we really hold almost no producers right now. I'm looking at ARC probably at the top on my list of companies that I would add in the near term, but my play has been through energy infrastructure and pipelines and things. We've actually taken all our money out of the producers recently, and absolutely, some of the heavy oil plays that are getting a lift recently, obviously, and what's going on with Meg, I'd be more inclined to lighten there. I just think, long term, those are great stories. Oil sands has great long term lower cost of productions compared to shale in the U.S. or anything like that. But I tell you start getting oil prices towards the $60 level again and breaking that, that's going to be a headwind for the entire sector. So, okay,
let's go to Roy calling from Vancouver today. Hi, Roy.
Hi, Marilla. Hi, John. Miss you and Marilla in the newscast, but welcome back.
Thank you.
To Market Call. John, I'm curious about the Brookfield Renewable Partners versus maybe Brookfield Corp. Which one is better, or which buy, sell, hold?
Okay, thank you for the question, Roy. John, Brookfield Renewables, is this in the Brookfield space? Which one do you like?
Well, from that point of view, from the way he's asking it, if you're going to be into Brookfield and you're saying which one, I'd probably be more inclined to buy Brookfield Corporation, get the whole gamut of their multiple holdings at a bigger discount than you've been able to buy them at for a while now. Brookfield Renewables is trading at a premium to the other renewable stocks out there. And renewables have been under pressure, obviously, from what's going on in the Trump administration, what they're canceling in terms of, wind and other offshore projects and some of the pressures you've seen. So, that's been a real problem for the group general. But if you're talking about strictly renewables, I'd be way more inclined to own Northland Power, which is a better valuation, better growth potential going forward than Brookfield Renewables, if it's just strictly the renewable sector you're talking about.
Okay, we will leave it there for this block. We have to take another quick break, but when we come back, we'll have a look at John's past picks. That's coming up next. Time now to go through John's past picks from October 1st, 2024, so under a year ago. At the time, John, you picked Varen on the TSX, which was, of course, acquired by Whitecap in May. You recommended at $8.68, acquired at $9.11, so 5% upside, 8% total return. And with Whitecap, did you get rid of your shares after Whitecap bought Varen? Did you keep the combination? What did you do?
No, Morella, we kept it. And actually, to be fair, I mean, if holders in May just took the Whitecap stock, your total return would be more like 25% over the year. And that's what we did. I mean, I just thought Varen was exceptionally cheap. And actually, Whitecap got quite the steal by being able to buy them at that price. It was, while markets were under pressure and there was some worries, and I think they got a great deal in that one. And like I say, I'm not particularly bullish on the oil producers right now, but we've maintained that smaller position in Whitecap, and that's sort of the only light oil producing name we have in the portfolio right now. Stuck with it, and it's like I say, it's expected more out of that initial, but when you get a stock taken over, you expect a better total return than 8%. But like I say, if you hung onto the stock, the new stock you got, you'd probably be about 25% over the year.
Okay, let's have a look at your next top pick from October of last year, which was Lightspeed, again on the TSX at LSPD. It was 22.18 at the time you recommended it. It's dropped to 16.77, so it's a 24% drop in return and a total return drop of 24% as well. What has happened over the last year or so with Lightspeed?
Yeah, so that's I broke my own cardinal rule on that one, which is never buy value in technology, which really works. But I remember when we were doing it the last time. I mean, the stock was down over 80% from the peak, and it was trading about 2 times sales, which is ridiculously cheap for the group. Dax de Silva had just come back to do a turnaround at the company, trading in the low 20s, and on top of that, they were looking at a corporate restructuring, so they were looking for potential buyers of the firm. All of that add up to some great potential, and it did initially run up into the mid 20s, and then no corporate buyer came out, and then they reported a couple of tough quarters as well as there's some customer problems, switching over as they try to migrate towards larger customers as well. Stock came under pressure. We had lightened up on when the corporate activity didn't happen. I got a little worried, so we took a lot of the position out, but then I started buying back on that first miss, and then he missed again. The stock traded right down to $12, and we put the full position back on. So we own it again. I own value in technology, like they're breaking the rule, but Dax de Silva's back running the show again. They're generating positive cash flow, positive free cash flow. They've hit that break-even point, so I think something might get done with us some more. So I got to give it another couple of quarters and see what happens.
All right, let's move on to your third past pick from last October, which is Atkins Realis, engineering firm, consulting firm, 55.72 at the time, a year ago almost. Now at 93.14, so a 67% upside for return, same for total return. Does this company, are you going to hang on to what you have? Is there more growth opportunity for Atkins Realis?
Yeah, there's still more growth ahead for this one, Marella. We still like the story. I mean, a lot went right for them. Like, first of all, they sold off their position in 407 ETR, which was, got absolutely great. I mean, 20 times operating cash flow, EBITDA, which was, I think, made a ton of sense. And they used that to pay down their debt. And then they also have been slowly, the old SNC with their long-term LS fixed price contracts, the turnkey projects, which the old thing, you bid X on a project and then any cost overruns and additional costs, and delays, which always happen, the engineering firm effectively has to eat. They've ruled off all those contracts now, and they're on as more pure engineering companies, so their margins have gone higher. So that's a positive. They got all the cash from the 401 sale, and then you've had this renaissance of interest in nuclear expansion again, and no one's better positioned than Atkins in terms of their knowledge of the CANDU reactors and their history there. So they've gotten a higher valuation out of that. So it's no longer trading at a discount to group, but I think the growth, we're just in town the other day just talking about the growth going forward and the potential on the nuclear side, and we've seen what the expansion looks like there. So it's been tremendous. So these guys, I think, will continue to deliver earnings growth. They've had a great move in the past year. I don't know if we continue to go at the same rate, but it looks like a great story, and it'll be nuclear driving this thing on better margins, and their balance sheets in far, far better shape too.
John, we will leave this part of the show right now. We're going to line up some more phone calls and some emails for J Zechner. He's taking your questions today on North American large caps. Back in a moment. Welcome back to Market Call. Anita is on the line in Markham, Ontario, with a question for John. Hi, Anita.
Hi, good afternoon, Marella and John. Thank you for taking my call. My question is on Apple. John, your thoughts on that? And I own almost all the Mag 7 stocks, and they're doing very well. Being September, I thought I would trim them all. What your thoughts on that, John, please? Because the minute I trim anything, the prices go up.
Yeah, and there is room for them to go back up, right? Some of them have fallen back. NVIDIA is the one I'm thinking of off the top. Let's start with Apple, John, if you don't mind, and sort of forward looking for a company that is going to benefit from that Google Alphabet antitrust decision.
Yeah, that's obviously a benefit for them. We don't own it right now, Earl. I just find it valuation-wise too expensive comparatively to what else is in the rest of the group, and the opportunity available there. I know they're doing actually a new user day today and sort of unveiling the next, I think, the iPhone 17 or whatever. But I mean, people are extending how, it's like cars, they're extending how long they hold onto their phones. The changes in them are not nearly as dramatic as they used to be. So I think the hardware end of the growth for this company has slowed down, the higher margin part. Obviously, the iOS, their software, that continues to grow, and that's been a bigger impact. But, for single-digit growth in earnings, which is effectively all you're getting here, I don't think this is worth a 30s plus multiple that they've been paying at. It's a great company, and I agree with your assessment generally of taking down some of these Mag 7 names. We've taken them all down, or having some of them we don't own. But Amazon I reduced a little bit recently. Apple we don't own. NVIDIA we took the position down a little bit. Even Alphabet on some of the strength this week, we sold down a little bit as well. I just think, they've had a tremendous move. It's not that there isn't growth going forward, but I just think it's an easy area to take a little bit of profits relative to the size people about the positions a lot of people have, and just look for other spots or put some money in bonds or some cash or some areas that are a little more defensive.
Got that. All right. We hope that helps Anita out as we move on to Brian in Belleville, Ontario. Hi, Brian.
Hi there. Mr. Zechner, thank you for taking my call. It's regarding Taiwan Semiconductor. It's been touted as the most important stock in the world, or rather the most important company in the world. It's been having a good run lately, and it's not as popular as NVIDIA or some of the other Magnificent Seven, but this is the company that builds all the chips. And I think the market is starting to discover how important this stock is. and I'd like your opinion of it. And do you see more upside? Thank you.
Okay, thank you for the question, Brian. Taiwan Semiconductors, and I just want to sort of put in the other side of things, which is Donald Trump wants to sort of put another duty on semiconductors. We know that is coming. He wants it to be a big one, but he always threatens that off the top. Where do you land on Taiwan Semi?
Taiwan Semi, we don't own it right now, and we've been reducing our position in the sector generally. And what you mentioned about Trump and the tariffs and what they're trying to do in semis, I think is one of the bigger risks right now. I mean, trying to move semiconductor production into the U.S., that's a failed, that is not going to work in the long run, absolutely. And, I think as well, the problem is I think the data center spending growth has definitely peaked. It'll slow, and obviously the input to the chips and the GPUs is going to decrease a little bit. And the valuations are certainly excessive in a lot of areas. But, Taiwan Semi, as Brian points out correctly, is sort of the manufacturer, the global manufacturers, the only one still doing foundries. Most of the other guys are on the design side or the software side and others. So that, they've got a core position they will continue to go on, and that's fine. It'll continue to grow. It'll continue to be a mainstay. It's a major player. The other thing I'll just throw on the side, I'll tell you, geopolitical risk. Taiwan right now, I don't know. There's enough risk in the markets with valuations and everything else. I don't know if I want a company based in Taiwan, given everything going on right now. And that's just me.
All right, good point to make, though. Something to keep a watch on. Let's go to Ben from Kingston, Ontario. He has a question today. Hi, Ben.
Hi, Marilla. John, good to see you again. My question is on Qualcomm. It has been fallen from grace from around 240 or so, right now around 160 or so. What is your outlook on Qualcomm going forward, please? Thank you.
Thanks for the question. What is your take on Qualcomm?
Yeah, we don't own it right now. We've owned it in the past many times, and it's been a problem right now with Qualcomm. It's cheap relative to the rest of the sector, and I won't debate that one. The problem is, they're really tight to the handset market. They've always been the old CDMA phones. They're obviously the Apple contracts are at risk of running out at a point, and that's sort of been their bread and butter for the longest time. And I don't know that you're going to see the same sort of growth in handset forwards that you've seen in the past. In fact, I'm convinced you won't. They try to migrate to what they called IoT, the Internet of Things, in the past couple of years, but that's still not a big part of the business. So, like I say, within the group, I'm not excited about semis in general. I'd be more inclined if I was going to be adding in areas where I see a little bit more growth and I see a little bit more sort of down market exposure to software and integration. I mean, Broadcom has had a tremendous run, but that they do a little bit more of that. Maybe AMD in that regard. So there are other names, but like I say, generally, I'd be more migrating into the software companies, the users of the technology and the implementation of the inference stage, as opposed to the builders, the bricks and mortar of the data centers and everything else, which have been the semis and the GPU manufacturers.
All right, we do want to get to another caller before break. Deborah's calling from Okanagan Falls with a question. Hi, Deborah.
Oh, hello. My question today, John, and I always appreciate your opinion, is on UnitedHealth. This stock has been pummeled from its $630 high, but today and the last couple of days, there's been signs of life. It's up 7% today. So my question is, long term, should I take a second position, as you like to buy things when they are cheap? So what is your outlook on this one?
Okay, thank you for the question, Deborah. Go ahead.
Yeah, that's a good question because, I've struggled with that as well. We didn't own it. I got lucky, so we weren't really there. But having said that, when a stock of that size, that magnitude, and that growth potential, drops more than 50% in a year, I always get tempted. So we put a small bid on for a trade a couple of weeks ago, and then, Buffett came out with his position in the stock, and that's given it more of a lift. Haven't made it a full position yet. I can still get around the nagging issues of what's going on with healthcare in the U.S., the payment systems as well. What's going on with the investigation into them, the criminal investigations, potentially coming through. So, that all just makes me think, okay, the multiple on this stock is going to be lower than it's been in the past. We've probably seen the worst. I also, we went on the PBM market as well, the benefits managers, which UnitedHealth does. I thought CVS was probably a cheaper, better way to play that. And we added CVS around the same time. It's also been under, a lot of pressure over the past year, but on a valuation basis, looks a lot cheaper. So yeah, we've probably seen the worst. I'm not comfortable enough that all their problems are past, the old cockroach theory, whatever you want to call it, that I would establish a major position in it at this point. But certainly you've de-risked it a lot because of the move we've seen this year.
John Zechner sticking around to take more of your questions in a moment. Stay tuned. Welcome back. Bert is on the line in Sudbury, Ontario, with a question for John today. Hi, Bert.
Hello. Good afternoon. My question's on Kinross Gold. Do you think it's a buy, sell, or hold at this point? Thank you.
Thanks for the question, Bert. Gold is something you hold. John, I know you'd like it. Is Kinross in your purview?
It's not. We had it for a while, and we sort of been reducing some of the positions. I think Kinross, to me, probably has less upside. They probably a little bit more. They migrated to some North American properties, but it's got geopolitical risks, to some degree, Africa, to create the Soviet Union, areas like that. So I just don't see as much upside. They're one of the better unhedged players, and obviously a major producer. But there's a few other sort of mid-sized players that I'm more inclined to stick with that are a little cheaper on valuation. Stock's not a great move, so we're a little bit more profit taking on that name.
Okay, do you want to mention one or two that you like better?
Stick around for top picks. You'll hear one in particular. And B2 Gold is one I mentioned before on top picks as well. Serious geopolitical risk in West Africa right now, but the valuation, I think, more than discounts that. Having said that, Merrill, I mean, all the stocks, it's getting tougher because all the stocks have, had a tremendous move this year. And the only, what argues a little in favor for a lot of the players is the index weighted thing, 11 or 12%. I can guarantee you most institutional investors in Canada do not have a weighting anything close to that. So there might be a little chase between here and year end to, get some of those names on and get the positions a little higher.
Got that. Let's move on to Kirk then, who's got a question. Kirk's in Toronto. Hi, Kirk.
Good afternoon, both of you. Many of us over the age of 40 will remember the Northern Telecom story and how it turned from a high-flying Canadian darling into Godzilla somewhat overnight. And I'm just wondering whether you see any echoes with Celestica or whether it's full value for money still, despite this huge run-up.
Okay, thank you for the question, Kurt. John, go ahead.
Yeah, you know what, Celestica, here, I don't see it anywhere clear to it, like another Nortel. I mean, I went through that as well. I'm 70 now, so it's like, yeah. I've been there, done that. No. And but no, Celestica. Problem I have with Celestica, contract manufacturing was always sort of the nuts and bolts, sort of the low end of technology. It was a low margin business, sort of 6 to 8% margins. Capacity drove everything, and you never got high multiples. You traded 10 to 12 times earnings for years. 4 or 5 times operating cash. So suddenly, they have done a tremendous job in the past couple of years of being front and center of data centers, back end, front end as well. And they've, had better growth, but it's still contract manufacturing. It's still a large business, and it's still cyclical. We had it, and, I sold it. We had tremendous run on it, and I was patting myself on the back. I've left over $100 on the table on this one. But, I mean, the stock was $10, 2.5 years ago. And now the valuation is way at the high end. I think we're talking about over 25 times operating cash flows, 40 times earnings. So I tell you, we've gone from one extreme to the other. So it's hard for me to say this is anything close to a buy. I mean, no, I exited the position. I left a lot of money on the table, and we made a lot on it at the same time. I cannot advocate owning it or buying it right now. I'm sorry.
Okay, I hope that is good for Kirk as we move on to Anne, who's calling from Scarborough, Ontario. Hi, Anne.
Oh, hi, John. Your opinion on Alamos Gold. I own Anico Eagle and Alta. Which one should I buy more of? Thank you.
Okay, so Alamos Gold, John.
Yeah, between Alamos, and if you're mentioning between Alamos and Agnico, I'd probably be more inclined to add to Alamos strictly on a valuation basis. Like everything in the sector has had a great move. I mean, it's are there obviously is their core production growth, and that is clearly a less risky geopolitical region, I think, than it used to be in the past. Stick around for top picks in a bit, and we'll talk more about Mexico and gold. We continue to hold Agnico, which is sort of now the premier name. We talked about Barrick earlier and some of the others, but Agnico is a premium large cap gold stock in Canada. So even though the valuation is extended and it's the highest in the group, it's got great growth going forward, and I wouldn't necessarily get out of it. I think Alamos might have a little bit more potential upside in the short term just because it's somewhat cheaper. But I've talked about in general that I think these gold stocks have moved a lot, so I'm looking for cheaper pockets, things that have lagged a little bit, and maybe I'll take a little bit more geopolitical risk in order to get that.
And I hope that's good for you as we go to an email from Bill. Bill says, hi, John. What's your outlook on Northland Power, and would you buy it? Northland has power generation facilities, but they're in Canada, U.S., and Germany, and they do a lot of cleaner power. Is this a company you like?
Really do. They've got two major projects they sort of brought online on budget or in process. They're bringing that past couple of years. Offshore Germany, as you said, it's offshore wind. It's the biggest market for them, and the Halong project and Halong Bay, offshore South China Sea as well. Brought those both on. I think these are great growth stories. They're generating cash flow, generating free cash flow. At this point, they've got a great potential projects going forward in the pipeline. And I think what people miss a little about the renewable energy stocks too, the capex is your big risk. Once you get through those big capital expenditures going forward, I mean, what's your cost of production? The inputs, well, nothing. Basically, it's wind, it's sun, so whatever. You got free inputs. Your bigger risks are building these projects, and once you get through a major building period, I think there's a real sort of harvesting period that I don't think investors are fully appreciating. And a name like Northland is just getting to that stage. I mean, developed a couple major projects over the past few years, and I think they got a few more in the pipeline as well on top of that. And they'll continue to develop them. But I think they're really going to start to generate some serious cash flow of that, and they're already got a good balance sheet and trades at a decent multiple on earnings and cash flow. Now, these things people got excited about them a couple of years ago, the early Biden years, and now it's got the other extreme. People really dislike the renewable energy stocks because of the current administration in the U.S. and otherwise. And I think there's more potential in some of these names, and Northland's at the top of my list.
Yeah, a lot of them are getting ignored, as you mentioned before, because of Washington and the agenda from there. All right, we are going to take another quick break, but John has new top picks. That's when we come back. Join us tomorrow on Market Culkin Bolton on the show. President Portfolio Manager at Black Swan Dexteritas. He'll take your questions on technology stocks. That's coming up tomorrow. Time now for our top picks from Mr. Zechner. His first on the list is Torex Gold. John, we talked a little bit about gold stocks and what you like and where you like. Why is Torex Gold your first top pick?
It's an interesting story, Morella, because it's traded at a big discount to the rest of the group for a long time. It's had a tremendous move over the past year, but they have this big Morelos property in Mexico. But probably at a discount because the El Limon open pit was really coming to the end of their natural life, and they're going to have to shut the mine down or sort of roll off. But what they've managed to do over the past year is there's a Media Luna is another deposit at the south end of the property. They've migrated to open Media Luna, get it going, get it on budget, on time, almost unheard of in the mining business. So they're not really losing a step in terms of their production. In fact, they got this, I think, I haven't been there to see it, but this 7-mile tunnel that goes so they can use the same facilities to move the ore from one to the other. At the same time, they've gone underground at El Limon and been able to extend the reserves there. So now they've got reserves that probably go out into the mid 2030s. They've extended it dramatically. They're generating free cash flow again. They haven't lost a step in production. Still trading at a discount to the group at around 5 times operating cash flow, at a discount to net asset value, in a geopolitically safe region the way I see it. So it's a great story still, despite the fact that the stocks had a great move. But I think that this migration from the El Limon to the Media Luna has been exceptional. And on top of that, at the El Limon underground, the periphery is going to be about 30% copper, which I think is great going forward.
Okay, that is your gold pick, Torex Gold. Let's move on to your second pick, which is Shopify, a name we all know pretty well on the TSX, and has bounced around a lot and does tend to bounce around a lot. Why do you like Shopify moving forward? A lot of room to grow?
Yeah, and this is not a typical pick for me. I don't like really highly valued stocks, and that's always been the argument against Shopify. But a couple of issues on this. First of all, on the revenue side, they really are delivering. I mean, they've upped their revenue guidance now in the past 2 quarters alone. So now we're looking sort of mid to high 20% revenue growth going forward. They've really found their market niche, sort of doing mid and small size businesses, and basically all of their online needs, delivering that. I think that's a market that continues to grow. Valuation-wise, it's expensive, but not expensive as a business. This thing's traded up to 25 to 30 times revenue in the past. Now it's about 10 times. But more importantly, it reminds me about Amazon about 8 years or so ago, where they're sort of spending a lot, but now they're hitting this cash flow break even. Once they break through that and they start their margins are starting to improve, then you can accelerate your earnings growth. And I think we're on the verge of that for Shopify. So I think we're going to start to see some better earnings growth. It will drive it cheaper on an earnings valuation basis. Revenue continues to be, mid-20s. They've got their market niche effectively. And it's now the biggest, the whole thing about, I think someone mentioned earlier in the show about, Shopify, the biggest stock in the TSX. I talked about Celestica in the same way. And, what happened to Nortel and Research in Motion and even Valiant in the past. You get to the top and it's, your days are numbered. That's not the case with Shopify. I think they have staying power up here. It's a great growth story, and they'll continue to deliver for their clients, their shareholders in Canada.
Yeah, $260 billion market cap for Shopify. Let's get to your third pick, MDA Space, which has been in the headlines this week. They lost the EchoStar contract, which was worth $1.8 billion. 100 satellites were going to be built for EchoStar. And so that has hit the stock this week. Is that why you've decided to pick it up this week?
Yeah, you're right, Marella. That was a quick change yesterday. We've owned this stock for a while. I've had it as a top pick many times over the past couple of years. Well, we had actually reduced our position, a couple of months ago, just because it hit our near-term price targets. But stock got knocked down 25% yesterday on the cancellation of the EchoStar contract, and that's and now it was trading at 39 when they announced the contract. It dropped all the way to 33 yesterday. So I thought it's trading lower than it was, before he even thought about the contract. So I thought that's a lot of punishment. Now, people are clearly worried about the growth going forward. But I think when you look closer sort of at the cancellation of the EchoStar contract, they announced it, but basically AT&T was paying $22 billion to get a couple of weeks ago to get space, to get some of their spectrum into the low Earth orbit satellite spectrum, and is an area of growth for them going forward. And this was maybe meaning that the EchoStar contract was going to go from 100 to 200 satellites, but instead now SpaceX has stepped in and made an even larger $20 billion investment, but they'll go up onto SpaceX's obviously onto their system, and that suddenly put MDA out of the picture. But I think they will find other constellations.
We're just running out of time, John. Sorry, go ahead.
There's growth there going forward. I like the stock. It's been on the cheap, and we're back adding to it again.
Got it. John Zechner, thank you, sir, for joining us on Market Call, and thank you for watching. We'll see you again tomorrow.